Good evening, ladies and gentlemen. My name is Alan Brugler. I'm the president and owner of Brugler Marketing Management LLC in Omaha, Nebraska. We're national and international grain market analysts, but we started this introductory series to help those of you who aren't as far along on your marketing journey to understand better what to do, how to do it, and some of the key concepts involved. The first two webinars were last week. They were on basic marketing and the reasons you need to pay more attention to marketing. We talked about cash grain marketing for those who don't want to deal with futures and options and things of that nature. And tonight we're going to talk about hedging and how that risk management process works. I'm going to first turn the microphone over to Ryan Nielsen, one of the analysts here at Brugler, and then he will bring along Austin Schroeder, and they'll share some of their viewpoints and expertise on hedging. So with this, I'm going to discontinue my camera and turn it over to Ryan Nielsen.
Good evening, folks. I actually don't have a webcam, but that's all right. We do have a pretty nice PowerPoint set up for you, so that'll be, if not better, than a webcam anyways. So as Alan said, my name is Ryan. I've been with Brugler Marketing for about 3 years now, since 2019. I've learned a lot in my time here, and I hope to share some of that knowledge with you guys. I'm joined here with Austin.
So, hey everybody, my name's Austin Schroeder. For those that haven't attended any of the other webinars here we've had, I've been with Alan for 5 years now, coming up on the 5th year anniversary. So, been with Alan a lot, learned a lot, and I guess we're excited to teach our knowledge to the rest of you. And if you got any questions, type it in the chat box, but I'm going to let Ryan kind of start it and I'll finish up here.
All right, yeah, so tonight's presentation is the third part of our 4-part series, and we're going to be talking about hedging. Before we get too far into that, there we go. Before we get too far into that, we have a quick NFA disclaimer. There's a substantial risk of loss in futures and options trading. That will kind of be key tonight because that's what we're talking about. NFA does not require us to say that you can lose just as much out the bin door, but we are required to remind you that there's a substantial risk in loss in futures and options trading. Such trading is not appropriate for all individuals. There's also past performance is not necessarily indicative of future results, and news may not result in the expected price changes. Known news is often built into prices via expectations. And lastly, this presentation is not meant to be seen as an endorsement of futures and options trading versus other hedging and marketing techniques. We're just going to kind of explain how futures and options trading works. So by the book, what is hedging, right? Here are a couple definitions. First from Merriam-Webster, the definition to enclose or protect with. If you think of hedges around your garden area, that's kind of where this term is derived from. But notice the alternative definition is to protect oneself financially. The example they gave was to hedge against inflation. Investopedia might be a little bit more along the lines of what we're talking about tonight. They define hedging as a risk management strategy employed to offset losses by taking an opposite position. Alternatively, they also define hedging as an investment made with the intention of reducing the risk of an adverse price move. Yeah, so essentially, pertaining to marketing, hedging is a tool to protect your inherent position, right? And again, more simply, as a grains producer, you are inherently long. We touched on that in the marketing segment, but by growing the stuff and having the stuff, you're inherently long. Elevators and end users are inherently short. So when you're protecting your inherent position, you're protecting, you're already inherently long, but you have risk to the downside. In other words, you know, if prices drop, that's money you no longer earn. Whereas if prices rally, that's extra money that you could get. So your inherent position is already long. Hedging is trying to pass that risk on to someone else, basically to protect your grain. And depending on the strategy and the delta, the profit from a hedge position can either compensate completely or varying amounts of the loss if prices were to drop. Hedge losses are either made up in full or in part against that cash position. So why would you go against yourself? Well, in a perfect world, you wouldn't. But newsflash, we don't live in a perfect world. Okay, so hedging allows you to control your price risk. And here's a nice little name tag for anybody if you want to print it out and wear it, because after tonight's presentation, you are in control, right? At least that's the idea. Some more reasons to consider hedging is good hedges will often pay for themselves, and bad hedges can be written off as a business expense if you're in the grain marketing and grain production business. Hedging can be simple. Of course, if you get to where it's a little more complicated, there are professionals, and educational seminars, perhaps such as this one, to help you learn. So why do you want to hedge, right? This graph actually shows unhedged returns for feeding cattle. This is by Kansas State. So it's, every feedlot has their own costs and their own basis to consider. So this is a little more regional to Kansas. It might not be exactly along the lines of your neck of the woods, so to say, but there's a lot of red on that graph. That's basically the point. If you're not hedging and prices are going against you, it doesn't pencil over time. Actually, the average you can see here is negative almost $36 a head. So over time, if you're not hedging, it doesn't actually pencil to feed cattle. That's why where hedging can come into play. All right, so what are some common marketing mistakes? We touched on some of these in the first seminar, or first webinar of this series. But sometimes folks make forced sales if they failed to plan for when they needed to make a sale, and all of a sudden the rug gets pulled out from under the market, and due to time constraints, now they have to take that lower price. Another common mistake is backyarditis. Folks might think their problem affects the entire country, or a U.S. concern is an entire global concern. And again, we touched on most of these in the first webinar, but here are a few more marketing mistakes. Refusing to cut losses short. There's a really almost humorous book by Jim Paul. It's called "What I Learned Losing $1 Million." The basic premise behind that book is his position went against him, and he just kept doubling down, and that's how he lost $1 million. If you bail out, if you think maybe you were right, but it went against you the first day, and you missed it at the top or the bottom, that's kind of the opposite of cutting losses short, but that's another way you can get in trouble. If you underfund hedges, and Austin will talk about this a little bit later in the show, but it does take money to make money, or in this case, protect it. You got to have margin requirements to meet the hedges. A Texas hedge can get you in trouble. It's actually not a hedge. It's a case of double long or double short. Greed is kind of the opposite of cutting your losses short, and that's staying too long. And then, of course, analysis paralysis. That can get you in trouble, because sometimes the best time to act was yesterday and the second best time is now. That's not always the case, but as it can get you in trouble, that's what we're referring to. And of course, there are different levels of hedging. You can go fully hedged. That's basically where you sell a futures contract against your entire production. If you do that, your price is basically fixed. In other words, exactly what it's worth, except there's still basis considerations, and basis, we touched on that in the cash presentation, but basis is basically your local cash price minus the board. And if your local cash price can still move relative to the board, so even though you have a board price set, there's still some basis risk there. And then of course you still have storage costs. So while your price is fixed, it's not necessarily fully set in stone, right? There's a few other moving pieces. You can be partially hedged. That's where you might hedge a smaller percentage. And again, we'll cover this a little bit later in the show as well. But an example of that might be like you buy some puts, perhaps against 50% or even 10% your grain. That'd be a partial hedge. There's some pros and cons with that, because now you have a price floor. In other words, your put would protect below or anything up to and below a certain price, but it leaves the upside for you. However, with options, there's also the Greeks risk, and basis risk is still a factor, and your price is not set. And then you can get into complex hedging, which is what our next webinar on 12/15 Wednesday, the playback's 12/16 Thursday. It'll cover those in a little bit more detail, but some complex hedges might be like a multi-leg strategy, bear call spread, bear put spread. You might go synthetic short. You can go straddles and strangles. There's a whole load of tools out there to help you accomplish hedging, which is, again, just passing that risk, however much you determine, whether it's all of it, some of it, or different pieces of it, you're passing that risk on to someone else. So a classic hedging example. All right, this next slide will basically just outline a pretty simple scenario, such that, let's say it's July, weather's good, crops planted, it's growing. Say NAS progress data is showing good conditions around the country, it's developing at a quick clip. Basically, it's looking like a good crop, okay, in the summer. National carry-in, say it's low. Last year might have had a drought, there was some concern, so you're coming out of a short crop. One thing that we like to point out in our more frequent monthly meetings is a short crop long tail. It's kind of the picture I'm trying to paint here, but again, it's all hypothetical. So say you're coming off of a tight crop situation and it looks like you might have a good crop. You're at the summer high. There's a risk premium built in because it's still the summer. Last year's shortage will likely be solved come harvest availability, and the recency effect has the two crop years tied together. So what's the situation? You're basically in the summer and you have a fear that prices will come down. All right, so you could sell now for harvest delivery. The risk there would be you miss out on higher prices later if a demand rally develops. I'm talking about maybe January or March. You could hold out for that demand rally, but it may never come. Of course, option 3 is a combination of 1 and 2. That's all on the cash side. You could sell some now and store the rest, or you could hedge, and you could sell the board as a hedge, lift at the harvest low, and sell the cash grain later. Now, again, this is a classic, and it's simplified in parentheses there, example of hedging. So we're going to paint two pictures of how this might play out, and just remember it's hypothetical. But if you go with hedging, the short position is likely to, assuming it works, is likely to offset some of the storage costs, possibly turn a profit. That profit could then be used to justify a later sale at potentially a lower price. Remember, because you're at the summer high in this situation. Or if a crop concern develops or a demand rally starts, you still have the cash grain to offset the hedge going against you. All right, so how does this situation work? If it works, right? So say it's July, December's priced at $3.90 with a 20-cent basis. Basically, we're just adding some numbers here so you can see the simple math behind it. At the harvest low, December dropped to $3.30 and basis got a little bit stronger. Okay, if you sold here, you'd make your 60-cent futures gain from $3.90 to $3.30, and your net price would be $3.75. That's your $3.30 minus your 15-cent basis plus your 60-cent futures gain. Or you could lift the hedge and store till March. If a demand rally comes, or even just a mean reverting rally comes, it might take futures to $3.70. Basis would probably get a little weaker typically. This isn't meant to be seen as a technical analysis piece, but typically basis gets weaker on a board rally. So we'll call it 18 cents under, and we'll just define storage cost as 3 cents a month. Okay, so if that's the case, then you would net a 37-cent cash gain going from 330 minus 15 is 315 up to 370 minus 18 is a 30-cent cash rally. You have to pay 6 to 9 cents in storage, but you still have that 60 cents from your hedge. So if you sold here, you'd get 346 for the cash, plus that 60 cents would have netted you a total of 406. Okay, and again, this is hypothetical, but that 406 would have been above your 370, and that's here if you would have sold at the summer high, because at the summer high, it was 390 in your 20-cent basis. So if you would have hedged to the harvest low, lifted it, and sold in the spring, you would have got 406 as a net price as opposed to 370. Okay, so what if it doesn't work? Say it's the same situation. Say it's the summer high, DEIS is 390, and there's same 20-cent basis. Say instead of a harvest low, December goes up to 420. Okay, and the basis, again, as the board goes higher, basis tends to get a little bit weaker, so we'll call it a 30-cent under, so the cash price would be 390. That would grant you a 20-cent cash gain, again, because board's up 30 cents, but your basis is down 10. But your short futures went 30 cents against you. Okay, so if that's the case, you would get your 390 for the cash, but you'd have to pay the 30-cent loss, and your average price would have been 360. Okay, so if that was the case, you sold here, you'd get 360, which is less than your 370 if you would have sold at the summer high. And again, can't stress this enough. This is way oversimplified, but that's kind of the point. We'll get into a little more complex here later in the show, but that's kind of how the math works. If there's any questions, you can definitely throw them in the chat box, or you can call the office or talk to myself or Austin, or send us an email or something like that. So I'll pause here for a quick question. I'm not seeing any, but again, the point is basically you can lock in the price. It can go against you, and if it does, you have a cash position to offset it. And if it goes for you, then that hedge helps offset the cash loss, basically. And there's a basis consideration there. Austin, would you like to talk more about basis?
Yeah, I sure will. Basis is your difference between your cash price and your futures price. But as basis, or as futures tend to rally, it doesn't always have to happen, but as futures tend to rally, basis does weaken a little bit. Now, depending on there's a lot of variables that have to go into this, but basis does tend to get a little bit weaker here as prices rally. Going back to the last example, I just wanted to point out, even if you're hedging and you get a loss on your hedge, right? On like the last example, I'm just going to go back really fast here. You could have sold at 390, right? You didn't, which with your 20-cent basis would have netted you a cash price of 370. Here you got 360 because of your 30-cent loss, and the basis weakened 10 cents. This is where basis really comes into play here. You know, typically if you hedge and you get this loss, you have the gain in the cash market to offset that loss. So you're not losing a lot of money hedging, right? Your hedge account might be down, but with the cash market rallying, the cash market is going to offset your futures gain. Here, in this case, this is where basis kind of comes into play, because basis weakened 10 cents. You actually lost 10 cents overall. So that's definitely one play you want to definitely consider, right? If you're hedging, you're long the basis, you don't have that long, or you don't have that set in stone. You basically have the futures price set, but you still have that basis risk. So you could hypothetically make money on your hedge, but you could still lose money on the overall position in general, right? So here's a good example. You gain 20 cents on your hedge, but you lose 25 cents on the cash side. You have a 5-cent loss overall when you go to sell in the cash market, and then add your futures gain of 20 cents. You're down a total of net 5 cents, but you still are definitely better off than if you hadn't hedged and you get a 25-cent loss here, right? So that's definitely something you want to consider, although you do still have that basis risk. The worst case scenario, obviously, with the hedge is the board rallies, the market goes against you, you lose money on your hedge, and the basis weakens. A good example could have been last spring. Board prices, rallied in corn over $7. If hypothetically, if the basis weakened during that time and you were short the board at $6.50 and the board went up to $7, you're out 50 cents on that futures rally, and basis got 15 cents weaker. Hypothetically, you're at a net of 65 cents just because of hedging. You know, that's a worst case scenario. It doesn't always happen, but that's definitely something that you have to be aware of if you are hedging. All right, so this is an example of kind of several things that can happen when you're hedging, right? So in this example, it's, you know, a producer is shorting or short corn futures, right? In this example, they're short at 4.50, right? So you sell corn futures at $4.50. And in this example, we're going to have several variables. We got, let me just, okay, so right here in this column, we have that the board weakens, right? So futures prices go down, right? Futures prices get worse. Board is neutral, you know, over the entire time here, the futures price, you know, when you enter and you exit the position, it's at the same price. You don't lose anything except your commissions and fees out the back door that you paid your broker and the NFA and the CME and etc. Right, and here you have the board, that the board strengthens, right? So instead of going down, board prices go up 25 cents here. In each case, you know, board's going up 25 cents, board staying the same, and the board prices are going down 25 cents. So 25 cents in your favor, right? Since you're short the futures market. Here we got that the basis strengthens, so basis is going to get a little bit better on your part. It's going to get, in this case, closer to the futures price, or you know, cash is going to get a little bit closer. It's not going to be as far away in the negative terms to the futures market here. Basis is neutral, stays the same, and basis gets worse, so you're getting less for your cash price, right? So those are some things to be aware of as we kind of go through this. As you can see here, what's going to happen in this example. So as futures price goes down, you net 25 cents, and then basis strengthens. So your basis is going to strengthen 15 cents. You know, instead of 30 under, it's going to be 15 under, right? So you're net gaining 15 cents there. So instead of selling, right? So let's just say this is an example of, I'm just going to throw an example out here, going back to Ryan's previous example. We're in July, we're selling for future December or October, whenever harvest delivery, right? So your cash price here is 420. That's where you can sell, let's say in July. You get out of your futures position at a 25-cent gain, and if you take that 25-cent gain onto your futures price, or excuse me, cash price, which is now at 410, you're going to net $4.35. Okay, so you know your overall cash price, you gained the 25 cents and you gained the 15-cent basis as the basis strengthened, right? So if basis is neutral here, you're basically going to get the same price because basis stayed the same. So for every penny that the futures market lost here, the cash market lost the same amount, right? So you're basically getting the exact same price you could have in July if you would have just sold then. Another example here, as the basis weakens, right? You have a 25-cent futures gain, but basis weakens 15 cents. So instead of your cash price being like $3.95 like it was here, if it would have stayed the same, it's now $3.80, right? So you're losing 40 cents on the cash price right here, see? So essentially in this one, you would have been better off forward contracting or whatnot for harvest delivery back here. Example number B here, where the board's neutral. Basis, basically you're just playing the basis game, right? So basis is going to strengthen 15 cents. You're basically just, you know, essentially in this example, you would be better off doing nothing and just kind of waiting for the basis to come to you. In this example, where basis stays neutral and the board stays neutral, literally nothing happens.
Not very common.
Yeah, well, exactly, not very common. You would have been better off, you know, taking your money and run, and instead of, you know, waiting on time, I guess. And in this example, basis weakens 15 cents, demand fell apart, and local demand fell apart, I should say, and you're out at 405. So just different examples of how we go. If the board strengthens, you're going to be out your 25 cents here on the futures gain. So, and in this scenario, you're out your 25 cents, but your futures price gained $4.20 is where your cash price was. It is now $4.60. Essentially, it would have been better off not hedging, but your basis gained 15 cents, so you help to kind of offset some of those losses there in your futures. So you're a net of $4.35. Example here, basis stays the same, but you're out 25 cents on the futures hedge, right? So obviously not the best thing in the world, but we'd like to see basis at least get a little bit stronger here. And as we get to the last one, basis weakens and the board strengthens, kind of to, like we said, the worst case scenario here. You're out to 25 cents on the board, and you're out another 15 cents on the basis there, and you're kind of just out 40 cents overall where you could have been. Just some examples there of kind of how things work. Definitely, basis definitely has a play when you think about hedging. It's not just how much can I make on my futures contract. It's definitely basis is definitely a play. Brings us to our next point. So you can hedge with futures, right? Some people like futures, some people like options. We're going to kind of go over options here briefly. We are having another webinar on Wednesday strictly over options, what you can do, how you can hedge with options, different strategies you can employ, different things you can do to kind of help make options a little bit more cost effective in your operation. But we use a lot of options in our advisory services, and that kind of we're just gonna kind of, I guess, help you to explore options a little bit more and just get exposure to kind of how we work. But for now, we're gonna go just a little bit brief summary here. So one thing about options, first and foremost, I'll tell you what options you do have. Options are derivatives of futures contracts, right? So you have what are called puts, which are an option but not an obligation to sell a futures contract or go short a futures contract, and calls, which are you have the option but not the obligation to go long futures, basically. Think of it in terms of calls are a price ceiling and puts are a price floor. That's a kind of a good way to think of them. In short, if the market goes down, your put is going to gain in value. If it goes up, your put is going to lose money in value. Essentially, that's kind of the gist of it. And calls, vice versa. If the market goes higher, you're going to gain the premium, and the call is going to gain in value. Versus if it goes down, your call is going to lose in value. Now, there's a lot more that go into those, and we'll definitely get into that. Your Greeks are big when we're talking about, it's not as easy as market goes up and the option gains in value if it's a call, or vice versa. There are definitely some different things at play here, but options, that's kind of just a brief summary of options here. Options are one directional, right? As I just mentioned, I guess the only money you can lose when you buy an option is as much as you pay for the premium, right? So if you pay 20 cents for a 580 corn put for March, that's all you can lose hypothetically if the market goes, to $8 tomorrow. Well, not tomorrow, but over time, right? So same thing with a call. If a call goes down, or if the market goes down, all you can lose is the premium that you pay for that option. You can use them in conjunction with others. Those we call those spreads, right? So you can, if you think there's downside risk in the market, you can buy a put, and but you think the downside risk is limited, and you think we're kind of in a choppy market, so you might want to sell a put below that put that you bought, right? So if it's, in this case, let's say a 580 corn put, you sell a 540 corn put. We call that a bear put spread. We'll get into that a lot more on Wednesday, but that's just some things you can kind of do. Greeks, so we use those as kind of help determine or describe options, right? So delta is going to be what delta is, the best way to describe it is the change in the option price, the change in the price of the option versus a change in the underlying futures contract. So, right, so if March corn futures go down 10 cents tomorrow, typically your at the money puts have a 0.5 delta. If the market goes down 10 cents, your option's going to gain in value. Your put option is going to gain in value by 5 cents, right? So for every penny move, there is a half-cent move in the option. Theta is basically your time value of the option, right? Let's say a March option is going to be a little bit cheaper than a July option, just because there's more time. You have more time on that option. You're paying for time in that case. Gamma is basically the rate of change in the delta, and Vega, which is volatility. We'll kind of get into that. Like I said, on Wednesday, we'll explain it a lot more in depth. Volatility, though, has a play in markets. When markets are very volatile, you'll see in 20, 30 cent moves each day in corn. Your options premium is going to be a lot more expensive, just because there's no certainty on where we're going to go. So they price them a lot higher. So, and obviously, as with anything, they require active management. So do futures, but options do as well. So be sure to manage them as well. Kind of explaining the difference here between options and futures. Futures, right? So just a couple brief differences here. Futures are, we've been talking about kind of in our examples here. What's the risk associated with futures? Unlimited risk. If corn goes, the limit here, 45 cents. I have that on the next couple slides here, I believe. But corn can move the limit tomorrow, right? And it can go the expanded limits the next day. Your risks are unlimited in futures, and you sometimes can't get out of if the market goes limit tomorrow, you may not be able to get out of your position because the market won't let you, right? The risk there is unlimited. Anyway, if you're buying options, right, your risks are limited, right? The only thing you can lose, kind of as I said briefly there, is your premium. And obviously with any futures or options, you're going to lose your commissions and fees and stuff like that. That's a given. But when you're talking options, you're buying them, risks are limited. However, when you're selling options, risks are unlimited. So that's definitely something to be aware of. If, hypothetically saying if you have a covered, what we call a covered, right? So if you have that spread I was talking about a little bit ago, a 580, 540 corn put spread where you sold the 540, that would be what's called a covered right. That would be essentially the risks there are limited because, as the value in the long put goes down or goes up, it's going to offset the short option. But if you're selling a naked option, your risk is limited. So be aware of that. But futures always going to be limited. You could think, okay, your long futures, your risk is somewhat limited because it can stop at zero. Well, last year we had crude go negative, so that's not always the case. If you're short, corn futures can go, it can go however high the market's illogical as long as you can remain longer than you can remain solvent, right? So definitely things to watch out for there. As far as margins go, futures have what are called initial and maintenance margins, right? So we'll kind of get into this in a second, but you have to have money in your account to put up as a deposit essentially for this futures contract, right? And you have to keep enough money in that account to, if you're out $1,000 on this trade, you have to keep money in that account to cover what's called a maintenance margin. And we'll kind of get into that a little bit more as well. For options, long options, you don't have margins there, you just have your premium. Whatever you pay for your premium, that's essentially what you can call margin. You don't margin them at all. Short options have what are called span margins. And that's basically on a naked option there. If you have a covered option that I was just talking about, there typically isn't a margin. You're typically getting credit for that short. Like, so if you sold that 540 corn put, you're getting credit for that against your long put, right? So let's say you sold the 540 for 10 cents and you bought the 580 for 20 cents, right? Your net that you're paying for that option is basically 10 cents, right? You're getting credit for that short option. So that doesn't have a margin, but if you have a naked option, that does have what we call spam margins. If the market's volatile, like I was saying a little bit ago, typically those margins are fairly pricey. The other thing you want to think about here too is if you sell a put and time goes on and it gets further away from the market and it's like $1.20 away from the market in corn futures, let's say, it's probably not going to have much margin on it. Margins are definitely something you want to look out for, and we'll get on to that in a second here. All right, on to the next one here. So next thing is kind of what we have, or what we call fractional hedging, right? So you, as a producer, let's just say you're a corn producer, have a certain level of production that you have to cover, right? So let's just say hypothetically your corn production is 100,000 bushels of corn, and that's what you're having to hedge, right? You don't have to hedge all that at once, right? You can hedge it in increments, right? You can go 20%, you can go 40%, you can go 50%, or you can do everything. How we do things is typically if we're more certain that there's a lot of downside risk in the market and the market's most likely going to go down, we're really have a really strong feeling that the market might go down, we'll probably be a little more aggressive in our hedging and maybe go 30, 40, 50%, on those hedges. It kind of just depends on the situation. You don't have to go fully hedged, and sometimes it pays to definitely go fully hedged, right? You can also do what's called delta adjusting. Like I said, if you have an at the money corn put, you buy, your delta is only 0.5, so you're only 50% hedged. If you have 100,000 bushels of corn, let's just say you want to hedge everything under the sun, and you do 20 contracts of corn, but you want to buy puts, you buy 20 contracts for the 580 corn puts. Well, you're only essentially going to be halfway hedged. If the market goes down 10 cents tomorrow, you're only going to be up 5 cents on that hedge overall. So if you delta adjust, you would basically at that point double, take the delta and try to get it to 1, which means for every dollar move in the futures, your options are going to move the same overall, right? Timing is definitely another thing. You have, when is it, right? Are we early in the season? Are we late in the season? Do you have cash already sold? What's your timing like? And also timing in terms of the market, right? So here we have, it works really well for the example that we have. It's a weekly hog chart. These big drops here are expiration gaps, but this example kind of really just helps to give you an example of when you would go hedging, right? So you start hedging here. You see we're have an MACD sell signal, right? This is a little bit of technical, but we're up against upper Bollinger Band resistance here. We see a big drop in prices. You get an MACD sell signal, so you decide to hedge a little bit, maybe 20%. Market kind of has a little bit of a dull period, and then all of a sudden we're getting bearish. So what do? Well, you might add a little bit of more protection here. Again, this is a weekly chart, so as you're going throughout the week, prices just get more and more bearish. What do? Well, you add more protection. You buy puts. As we get further on, you see that okay, MACD is kind of slowing up here. You're kind of coming down here to retracement support. So what do? You get out of your futures, and the market does what it wants, but you gained all of this down here. You just kind of legged into it in a sense. All right, we also have what are called calendar hedges. Hedge where and when until you intend to sell, right? So you can think of it as, okay, this would almost be keen to a what's called like an HTA, except you're putting up the margin essentially. But HTAs, you're setting a delivery date, you're setting a delivery price, and you're holding that. Essentially, not you, the elevator or whatever end buyer is holding your contract to that date. But essentially here you're holding, you're selling, you're shorting the futures, whatnot, and you're holding that until you intend to sell your cash, right? So you're basically riding the market with until you tend to sell. This would kind of be more of a true hedge. You're not you're basically just hedging. You're setting a price and you're letting the market do what it wants, and you locked in whatever price you set, obviously minus your basis, right? You can hedge the current crop in the field with harvest delivery there. You can kind of hedge that way, and you can also hedge the current marketing year. You can hedge next year's crop, whatever, go as far out as you want. There's different combinations you can do here. You also have to think about cost or carry, the cost in the market, the carry in the market. You have to think about that when you're hedging as well.
If you were to do a calendar spread, try and lock in your carry, there's a few things to consider. You're not fully delta neutral because the contracts, both being corn, they're obviously linked, but obviously the front month can go a little bit faster than the back month or vice versa. So the spread or the carry can get wider or tighten. So while you might lock it in, it doesn't necessarily, it might not necessarily be locked in, right? So here's a quick example. Say the elevator charges 3 months in storage. July beans are a 25-cent premium to Nov. So with that, if July is a few months out, that'd be 7 months out. 7 times 3 months of storage, you'd have to pay the cash side. That's 21 cents, but the board's offering a 25-cent carry. You could basically sell the July and buy the Nov and lock in that 4 cents, except like I said, that might not be fully delta neutral. And when November is ready to roll off the board, you'd have to roll it or exit the spread altogether. And that 4 cent quote unquote carry profit might not be there anymore. Austin, was there anything else you wanted to add?
Yeah, no, that explained it pretty good there. Yeah, you're just using a calendar spread there to lock in your carry or protect against your carry. So good job explaining it there a little bit more. And here we have basically what months you have for delivery when you're talking grain options. These are basically the contracts that we have that you would be able to use in terms of a calendar spread. For corn, for beans, there's a lot more spread out. You can essentially say, September is your front month, or excuse me, your new crop contract. A lot of guys will hedge in the December, but if you get further south, some guys might be able to hedge in the September. But that just kind of gives you an example of what we have in terms of available contracts there on the CME. So when we're talking contract specs, getting a little bit more into futures and what how you would go about hedging your grain for let's say corn. Your contract size on the corn is 5,000 bushels. So if you have 100,000 bushels of corn, you got to think, okay, how many contracts do I need to go X amount of hedged, right? So if I want to go 20% hedged, that would be 20,000 bushel. I need 4 contracts to either go short, buy puts, etc., so on and so forth. For grains, they are settled. They are deliverable, right? So grain futures have a delivery. You can deliver on a futures contract. Typically, we're out before any sort of delivery would take place, just because a lot of our guys don't have access to the warehouse where you would need to deliver. There's certain points you need to deliver. Some guys are 1,000 miles away from it, so it doesn't, you can't deliver. So we're out by then. But that is how these contracts settle, is they are delivered against. You also have what are called mini contracts in the grains, corn, beans, and I believe wheat all have mini contracts. Basically, they're 1,000 bushel size. They allow you, if you're a smaller producer and want to hedge a certain percent, let's say like on beans, if you only produce 20,000 bushel of beans every year, you might, or well, maybe that's not a great example, but if you only produce, let's say 15,000 bushel of beans, you might want to consider using a mini contract. That just kind of allows you to only hedge 1,000 bushels at one time versus 5,000. And livestock also, contract size for fat cattle and lean hogs, their contract size is 40,000 pounds. For feeder cattle, it's 50,000 pounds. For live cattle, hypothetically saying if you have 120 head of cattle, right? You're typically going to have about, if you are hedging at 1350 at an exit weight there, you would typically have about 4 contracts, 29 head per contract, 29 to 30 head per contract at that size. Some guys go bigger, some guys go smaller in terms of what their finishing weights are. Feeder cattle, their contracts are 50,000 pounds. Those vary. If you're selling feeders at weaning 500, 550 pounds, that's going to be a lot different than if you're selling calves at your backgrounder and you're selling calves at 850 pounds, right? You're going to have a different number of futures contracts. It's definitely something to keep in mind there. For settlement, live cattle futures are deliverable. You can deliver against your futures contract there. If you're short, there are a little bit more delivery points there for live cattle, depending on where you are. So it might be easier there to deliver against the board on cattle futures, but versus the grains in the previous example. But onto feeder cattle and lean hogs, those are both cash settled, so you can't deliver against those at all. They're strictly cash settled, and that CME keeps a pretty good track of that. To get the settlement price, they have what's called a lean hog index and a feeder cattle index that they use to settle those contracts. Now, I also have this little graphic here. This kind of just gives you an example of limits for each commodity here. Corn futures have a 35-cent limit here. If the corn futures, I believe it has to be a couple front month contracts, at least maybe 2. I can't remember if it has to be 2 or 3. Settle at the limit, 35-cent limit here. They have expanded limits and they can go 55 cents the next day. That's their limit. And same on down the board here. Bean limits are 90 cents. Meal is 25 cents a ton. Bean oil is 4 cents a pound. Chicago wheat, 50. Same for Kansas City wheat. Minneapolis is 60 cents bushel. And live cattle are $5. So live cattle on any given day at the moment can move $5. Feeder cattle can go down to 6.25 here, and lean hogs is 4.75. So that's just something to keep in mind too. They do have price limits on the futures contracts. These are the respective limits that they can move in one day, and then if they would settle at that limit, they can move this expanded limit. So that's definitely something to watch out. Again, as I said earlier, if hypothetically we're locked limit on corn futures and you are short futures and the futures are locked limit up, you may not be able to get out because what you're trying to sell at, there's no bids. There's no bids that are going to buy anything you're trying to sell. They're just locked limit up. You can't get out. So that's in options you can, but typically you're going to pay out the wazoo if that's the case. If you're have puts on, you want to get out, you can get out, but in that case you're going to be kind of a hurting unit, especially if you're short or long puts. May not let you get out on those, or they'll make you pay. But it's definitely something to keep in mind too. Also, one big thing here, hedging isn't cheap. We have what is called margins that you have to put up against those contracts. If you do plan on using futures and options, margin, you have to have margin money in order to buy or sell futures contracts. When options, you have to pay for the premium. and then we got back to short options. You have to pay premium, or excuse me, you have to have a margin to against that short option as well. Anyway, you have to have margin money. That is one thing you have to have. That's why hedging isn't cheap. It isn't free. Now, if you do an HTA, something like that, of course, you don't have to put up that margin money, but you do have to put up margin money if you have your own broker account, your own account here. Basically, margin money is money you must deposit and keep on hand with your broker. The broker has it, and they can use that to buy or sell futures contracts. They keep that. Typically, it's with whoever they clear through, whether it's ADM or whoever, RJO. There's they can clear through several different clearing houses, but it's typically kept on hand with them. Initial margin is the money that is required to initiate that futures contract, right? So if you're selling the board, let's just use this as an example. I have this. All right. Let's use this as an example here. You're selling a futures contract. Okay, I have this neat little example of what the current margins are. This is from ADM, their margin sheet. But if you're selling futures contracts for corn, this is for March, they kind of vary for whichever month they're against. They kind of get a little bit cheaper or a little bit less in terms of what your margin is, if May is a little bit cheaper than March. But for corn, if you want to sell futures, you have to have a margin of $1,450 if you're a hedger, to short futures or buy futures. Initially, you have to have $1,450 to initiate that position. Now, your maintenance margin is a level that your margin account has to maintain in order to stay in those positions, right? So if futures go against you, and let's say your overall on one contract down $500, right, and your margin account dips below the maintenance margin level, you have two options, right? You get what's called a margin call. Nobody likes that. Nobody likes that word. I guarantee your broker does not like making that call. Nobody likes getting those calls. It's horrible, but it's the way it goes, right? You're either going to have to add funds to build that margin money or margin account back up to at least your maintenance margin level or more, or you're going to have to liquidate that position. If you take a week to get your margin check, or margin money in your account, I guarantee no one's going to allow that to happen. They're probably going to liquidate your position just because you can't, and it'll come after you for that money that you would have to make up the difference there. But that's just something to be aware of. You do have margin calls or the risk of a margin call associated with your hedging account, right? So definitely something to be aware of. But this is kind of just some of the margins or initial margins here, for at least for hedgers that we have available, right? So soybeans are a little bit more expensive, $2,650 a contract, right? So you have to have that to initiate one contract. So an example, if you want to hedge 5 futures contracts, you're going to have $7,250 in your account to initiate that position, right? If you want to sell futures. And if they go against you, you have to at least keep a maintenance margin to that certain level. So that's just something to be aware of. Hedging is definitely not cheap. You have to have the money to do it. But again, if you want to help protect your risk, it definitely hedging is one way to lock or pass on that price risk. Okay, as we kind of close out here, things to remember. As I just said, hedging passes your price risk on to someone else. That is the number one thing to think of when you're hedging, right? If price goes up, there's a risk for every reward. You're passing on that price risk. Someone else is risking the price going higher, and if it does, and you're short and they're long, they get the reward, right? You don't get the reward because you pass that risk on to them. Your hedging is passing that price risk on. Typically, you're saying if you're going short the board or hedging, if you're a producer, you're saying, okay, this is a profitable level I can price at. Let's say you're 50% sold. don't necessarily want to forward contract anymore for harvest delivery because you're uncertain if you're going to have the production and you don't want to get too sold here. You can hedge instead of, by hedging, you're not locking in delivery essentially because you can exit that futures contract before it delivers on. So, but in terms of hedging, you're passing on that price risk to someone else, right? If you hedge and prices go against you, typically your cash position is going to offset the loss in your futures position, right? So we do have mostly there because there is a basis factor that if your basis weakens by a dime, you might be out that other dime. But typically, if you hedge and prices go against you, you do have that cash position that should offset most of that loss. Also, things to remember, as we said in that NFA disclaimer, there is a substantial risk of loss in futures and options trading. Not guaranteed here. You're not guaranteed to make money. As Ryan said too, one of Alan's axioms is you can just, NFA doesn't allow us, or doesn't require us to say you can lose just as much out the bin door if you don't hedge and you don't protect against that price risk, it can go down. Your cash quantity can go down. And finally, such trading is not appropriate for all individuals or entities. It just kind of shows or reminds you that hedging is a great tool that you can use to pass on price risks, to help marketing, to better your marketing, but it is not appropriate for everyone. If you don't you don't have a lot of liquid assets and you don't have a lot of money in the bank, and you have to go to the bank for a loan to put up margin, and you lose a bunch of money, that's just a scary example of what can happen. But if just always remember that stuff when you're thinking about hedging. So this is just kind of a little plug, I guess, for watching this free seminar, or webinar, excuse me. But we do have services available that can help you with hedging. AgMark Professional is strictly a daily advisory service that we put out. It kind of gives you daily advice, not only hedging, but cash only, or cash advice, right? Everybody's going to sell cash. So if it's not a hedging advice, it could be a cash advice, etc. Right? We also have special research reports, which kind of are just digest specific market items that might be going on in the market, or just gives a general understanding of different things, research items and such. But we are here to help. If you have any questions, feel free to email us. You can email me at austin.s@bruglermktg.com, or you can email Ryan. I'll let him tell his email as well.
Yeah, you can email myself at rnielsen, that's RNIELSEN @bruglermktg.com. You can phone us in right there. That's the phone number for the office. You can ask to speak with me or Austin. And don't forget to tune in to the options seminar or webinar that would be this Wednesday. Austin actually did a great job of talking about options earlier in this presentation, but that'll kind of, I guess, digest it and provide a little more in-depth on the options, because options, like we mentioned here, are one directional. Futures do carry that risk as well. If you were an ag market professional, you'll see that we actually advise a lot more with options than we do with futures. We do both, of course, but that's what next Wednesday's webinar is all about, is how you can use options as part of hedging.
Yeah, and I might have done a good example, but we'll have a lot more examples in our next webinar that'll kind of make you scratch your head a lot less. I'm sure some of those Greek terms I threw out were a little bit may not have understood them just based off what I was telling you, but definitely if you're interested in options at all, or interested in learning more about options, tune into that. It's options strategies, don't have to be just buy an option and hold it till expiration and let it, or exercise it or whatnot. It can be a lot more elaborate than that. So
yeah, and that's kind of the whole point of these PowerPoints and this free webinar for you guys, is to see how this stuff works. And a lot of the examples that we use so far today, they are, like Austin said, a little more simple as far as just you bought a put and you held it. You'll see on Wednesday, it's a lot more. There's a lot more that goes into it. It's not so much just buy and hold. They do require a lot more management, and that's why we actually offer the services. So if there's any final thoughts, Austin, otherwise I say we could probably end this up. I'll quickly scan the chat box for questions.
Yeah, no, I hope everybody, I guess, got, if they didn't get a lot out of this, hope they got something, and just kind of help expand your knowledge on marketing and hedging for today anyways. If you have any questions, like I said, email us, call us, whatnot, just let us know and get at us, and we'll help you out.
All right. Thanks, you guys.